And here to help make sense of it all, I'm pleased to say we have Herman Chan of Bloomberg Intelligence joining us now. Talk to us about what we learned yesterday. How surprised were you?
Yes, so it was surprising across the board on a number of different fronts. The dividend was cut to 5 cents a share. They are talking about not growing the balance sheet this year from the loan standpoint, and have targets for capital and liquidity that were a surprise to the streets. And then on top of all of that, there were some credit quality concerns with some losses in the portfolio with respect to multifamily and office lending.
I think it really speaks to the nerves of this market that you take a look at CRE and the broad-based indexes, and they're down pretty significantly again today. And I guess the big question is this an idiosyncratic issue to NYCB, or is this something systemic that we should be keeping an eye on?
Right. So it's a little bit of both. So the idiosyncratic part is that New York community, when they acquired Signature Bank last year, they tipped over the $100 billion asset mark, which ushers in higher capital requirements and will require New York community to undergo the stress test later this year. So in order to prepare for that, they needed to shore up their reserves, their loan loss reserves, and also their capital. That's the idiosyncratic part. The systemic part may be more towards the concerns about commercial real estate, specifically office commercial real estate, and specific to them, they have a big multifamily apartment lending component, which is a bit constrained in this current environment with high interest rates and New York rent regulations.
Okay, that's really interesting. And of course, you mentioned there's a lot of issues here. It's not just commercial real estate, but really quickly here, are we going to see other banks pop up with these CRE issues?
Right. So the good thing is that the CRE issue will be an elongated cycle. So we could see some losses in 2024 this year, but then it could happen through over the next few years as these loans mature. The other good thing is that banks are prepared because they know the cycle is coming. So they've already built up a lot of reserves, and the Citizen CEO had mentioned that things are in the back view, and they've already built their reserves 10% of their office exposure. So it's a known threat that's coming. So from that standpoint, nothing should surprise the industry on that front.
Well, we'll see if that logic holds. And if we do get some more surprises here, Herman Chan, great to see you. Thank you so much, of course, from Bloomberg Intelligence.